Welcome to our deep dive on the Mega Backdoor Roth and why once-per-year conversions can still be incredibly powerful. We will walk through how the strategy works, how to time your conversion, the tax mechanics, and an actionable plan so you can keep compounding tax-free. Let's get started. In this agenda, we will first define the Mega Backdoor Roth. Next, we will explain why annual conversions remain highly effective. Then, we will discuss optimal timing and the tax mechanics, including how Form 1099-R reports taxable amounts. After that, we will provide a step-by-step plan and some employer plan strategies. Finally, we will test your knowledge with quick quizzes. The Mega Backdoor Roth is a strategy where you contribute after-tax dollars to your 401k and then convert those funds to a Roth account, often either a Roth 401k via in-plan conversion or a Roth IRA via distribution. This goes beyond standard elective deferral limits and leverages the higher annual additions limit set by the IRS. The purpose is to move significant amounts into a Roth environment so that future growth can be tax-free. Here is the high-level flow. First, you make standard pre-tax or Roth elective deferrals up to the 402G limit. Separately, if the plan allows, you make after-tax, non-Roth contributions into the after-tax subaccount up to the overall annual additions limit. Then, you convert those after-tax funds to Roth, either via an in-plan Roth conversion to Roth 401k or by distributing the after-tax balance to a Roth IRA. Finally, once in Roth, the funds can grow tax-free over time. Let's compare annual conversions with frequent conversions. With a once-per-year approach, you face fewer administrative tasks and simpler tracking, though you will likely have some taxable earnings at the time of conversion. Timing the conversion near year-end helps minimize those earnings. Conversely, monthly or quarterly conversions can further reduce taxable earnings because less growth accrues before each conversion. However, this requires more frequent administration and a plan that allows multiple conversions. Both approaches build Roth balances, but the annual method remains highly viable and typically simpler when your plan restricts conversion frequency. Converting near the end of the calendar year is a powerful tactic when your plan only allows one conversion annually. First, you minimize the earnings that build up before conversion, which reduces the taxable amount. Second, you continue investing and contributing throughout the year so your after-tax dollars are working for you. And then you convert when you are close to year-end. Third, coordinate with payroll to ensure you reach your after-tax targets before year-end. Finally, avoid delaying into the next year, which would allow more earnings to accrue and raise the taxable portion of the conversion. This timeline illustrates a typical annual cadence. During the first 3 quarters, you continue making after-tax 401k contributions. Early in the fourth quarter, you verify your plan's rules and your contribution totals against the annual additions limit. Mid to late in the fourth quarter, if you are approaching the limit, you coordinate to avoid over-contributing. Then, near year-end, you perform the conversion either in plan to Roth 401k or as a distribution to a Roth IRA. Finally, at the start of the next year, you receive Form 1099-R documenting any taxable earnings and report them on your tax return. Here is the key tax rule. The after-tax contribution basis is not taxed when converted. Only the earnings that accrued on those after-tax contributions are taxable in the year of conversion. Your plan administrator will issue a Form 1099-R reporting the taxable portion. After conversion, as long as you meet Roth qualified distribution rules, future growth is tax-free. This is why minimizing pre-conversion earnings by timing the conversion near year-end is valuable when limited to a single annual conversion. This example assumes $30,000 of after-tax contributions and $600 of earnings at the time of conversion. Only the $600 is taxable when you convert. At a 35% marginal rate, that would be $210 in tax. After conversion, your Roth balance is $30,600, which can then grow tax-free, subject to Roth rules. Quiz time. The question is, in a Mega Backdoor Roth conversion, which portion is taxed in the conversion year? The options are A, the entire converted amount, B, only the after-tax contribution basis, C, only the earnings on after-tax contributions, or D, the employer match. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. Only the earnings on the after-tax contributions are taxed in the year of conversion. The after-tax basis transfers tax-free. Here are the practical steps. First, confirm your plan supports after-tax contributions and either in-plan Roth conversion or distribution to a Roth IRA. Second, estimate how much room you have under the annual additions limit, noting that these limits adjust each year. Third, enable after-tax contributions and automate deposits. Fourth, invest the after-tax subaccount appropriately, but remember that pre-conversion earnings will be taxable. Fifth, toward year-end, perform the conversion either in plan to Roth 401k or by distributing the after-tax funds to a Roth IRA. Sixth, keep the Form 1099-R that reports taxable earnings and ensure it is reflected correctly on your tax return. Finally, repeat this process annually and reassess your contribution levels and timing. This mind map organizes the major decision points. First, verify plan support for after-tax contributions, in-plan Roth conversion, and in-service distribution. Next, understand the relevant limits including the elective deferral limit, any employer match, the overall annual additions cap, and catch-up contributions if age 50 or older. Then, plan your timing by contributing throughout the year and converting near year-end to reduce earnings. Consider taxes, specifically that earnings are taxable at conversion and are reported on Form 1099-R, and that Roth qualified withdrawal rules apply. Finally, evaluate alternatives such as the Backdoor Roth IRA, an HSA, and a taxable brokerage account. If your income is too high for a direct Roth IRA contribution, consider the classic Backdoor Roth IRA. Many high earners complete the Backdoor Roth IRA first and then add the Mega Backdoor Roth for additional tax-free space. Remember to review pro rata rules if you have existing pre-tax balances in traditional IRAs before executing a Backdoor Roth IRA. Here is the second quiz. The question is, with a once-per-year conversion rule, when is the strategically superior time to convert? The options are A. Early January, B. Mid-year, C. Near the end of the calendar year, or D. Skip conversion entirely. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. Converting near the end of the calendar year minimizes the amount of earnings that accrue before conversion, which helps keep the taxable portion small while still allowing you to invest throughout the year. To improve your results over time, consider advocating for plan changes. Request that the plan remove any one-per-year conversion restriction. Ask for support for automatic or recurring in-plan Roth conversions to reduce taxable earnings. Also, request faster processing windows and clear online workflows to streamline the process. These are the main takeaways. First, annual conversion remains highly effective for building tax-free wealth. Second, convert near year-end to reduce taxable earnings. Third, only the earnings are taxed at conversion while the after-tax basis moves tax-free. Fourth, the Form 1099-R documents those earnings for your tax filing. Fifth, consider completing the Backdoor Roth IRA if income limits block direct Roth contributions. Finally, where possible, lobby your employer for more flexible conversion frequencies. This content is educational and not tax, legal, or investment advice. Consult a qualified professional who can assess your individual circumstances. Contribution and addition limits change annually, and plan features vary by employer and provider. To conclude, the Mega Backdoor Roth remains powerful even when limited to a single conversion per year. Timing that conversion near year-end helps keep taxable earnings small. Track your Form 1099-R carefully and file correctly. Advocate for plan improvements where possible, and layer this strategy with the Backdoor Roth IRA when appropriate. Thank you for watching. If you found this helpful, please like, share, and subscribe. In the comments, let us know how you plan to time your year-end conversion and what questions you still have.